Joining me now in the studio is Simon Derrick, Chief Currencies Strategist at Bank of New York Mellon. Thanks very much for coming in, Simon. So, US President Barack Obama may be talking about the spirit of cooperation between the US and China, but it didn't stop him from pressing his counterpart, that ongoing issue, the yuan, still too low.
Yeah, I mean, the currency war story is still absolutely there. And looking at the statement that came out overnight, it was very apparent that it still is. Clearly China has been pressuring the US with regard to monetary policy and its concerns that, frankly, it's more than happy to let the dollar continue to weaken. On the other hand, the US continues to bring pressure to bear on China to increase the pace of appreciation. But there was nothing in what was said overnight that suggests there's been any significant shift. And therefore, the question is really, what's China going to do next? Are they going to look at what's happening with their build-up in reserves and the amount that continues to pour into the dollar? Are they going to look to try and push that somewhere else, or increase the amounts that go into currencies other than the dollar?
And the US consistently saying that it might be appreciating, but it's not happening fast enough. Would a rapid appreciation of the yuan be a good thing?
I suspect not, actually. I mean, in fairness to China, I mean, it has been allowing the yuan to move at as fast a pace as it has done at any point in the past decade. Certainly what you're seeing at the moment is equivalent to 2007. And we do continue to hear from the Commerce Ministry that it would actually make a fairly severe dent on the trade balance if it started to move at a much faster pace. The issue here is not about whether they revalue or don't revalue. In truth, it's about currency liberalisation, about the fact that it can move two ways and that people can actually invest in the country. That is going to happen. It's just the timing. I think the next 5 years before something really happens.
But the Chinese, as you pointed out, you alluded to in your first response there, that, I mean, they argue that, hey, the US is doing the same thing. They're manipulating their currency with stimulus policies like QE.
Well, the point for the US is that anybody can play in the US market. China can invest in the US. It's not the same the other way around. The US can't invest in China. But the point is that it's about the political reaction or the practical reaction that China is going to have to the fact that the US is going to continue to run loose monetary policy and loose fiscal policy. And there's been a growing number of comments coming out from advisors and senior politicians that suggest that they're really quite keen to increase the amounts at the margins that they're going to move into other currencies. The Chinese are going to move to currencies other than the US because they are concerned that the US is running. Yeah, exactly. And that explains so much as to why they continue to provide this verbal support for peripheral Europe. They need Europe to survive. They need it to be a credible alternative reserve currency.
But given the extent of China's investment in US holdings, that's not going to happen anytime soon, is it? This is like a long-term thing.
Absolutely. And I think one of the really important things is going to happen here. Nobody is, for the one instance, suggesting that China is going to actively divest from its existing US holdings. What we're really saying is that the pace of build-up of fresh holdings in the United States may be at a rather more modest pace than we've seen over the past decade.
So European debt, the euro, more attractive than the US, or at least an alternative in some ways. How long-term, how is that strategy, that shift in policy, going to impact the US economy?
Well, in the long term, one of the things that possibly will do will keep upward pressure on prices on the US Treasury market. So there will be, relatively speaking, a tightening at the longer end for borrowing rates. But if the US is happy enough to continue to allow the dollar to decline, and of course what we're hearing from China would just exacerbate that, you end up with a highly competitive United States. So maybe the US isn't that worried about it.
Just want to ask you, Simon, about a comment that you made on the euro. Have to ask you about the euro today because it's actually not doing too badly. It's been pushing through that 135 level bit by bit. You've said the euro will survive, but that's largely because we don't see how you unscramble the omelette. What do you mean by that?
Well, very simply, I think that it's about the question of once you join the euro, it's very easy to join, but to work out the practicalities of somebody leaving the eurozone is so difficult and so damaging when you start to think about it. You realise that whilst in theory it's possible to leave, in practice the damage it would do to the economy is just unthinkable. And therefore, once you made your bet, I think you've got to lie in it.
OK, we'll come in again. Simon Derrick, Chief Currencies Strategist, Bank of New York Mellon. Good to talk to you.